All right, we'll sit on a very short break. Come back, talk to Mr. B Thiagarajan, Managing Director at BlueStar, get some trends out of the way as to what's playing out in that side of the market as well. Also, crude has come off. How does that impact margins? We'll get a sense on the other side of this break. Welcome back, and corporate conversations continue here on ET Now. Let me bring on board Mr. B Thiagarajan, Managing Director at BlueStar, joining us this morning. Mr. Thiagarajan, great having you. It's been a tough summer. What's happening on the pricing front and on the volume front? Is it far better than what you were penciling in Q1?
Good morning, Harsh. It's a pleasure interacting with you.
Very good morning,
at the end, it didn't turn out to be a tough summer, so somewhat disappointing in terms of margins. Though the summer had set in somewhat late, it continued well till around 1 week ago. And I think the industry would have grown around 35% in terms of volumes and around 30% in terms of value. So I don't think summer is a disappointing one. But the disappointment is in terms of the margins. We couldn't pass on, and I don't think the industry could pass on the entire cost increase, which was to the tune of around 13% till May. I think somewhere around 5-6% only would have been passed on. That is the only issue.
Mr. Thiagarajan, I meant it as a tough summer from a consumer standpoint because it's been extremely hot, right? And therefore, there is a need to kind of cool things down. But give us a sense, therefore. You've said 25% on the volume side, 30% on the value side. But you've said something important there, that margins have been a possible problem. Talk to us about how quickly that unwinds. We've seen crude come off quite sharply. Does that unwind for you? And in terms of pricing, have price hikes been far more than pricing in a $72 on crude? Have price hikes priced in $85, $90 on crude? How should one look at those two trends?
There are multiple angles. Number one is connected with the prices of the metals, copper, steel, aluminium. This is one part. Second part is connected with the exchange rate. Summer pressure partially was offset by you had imported material ahead of the season. Now you are importing at much, much higher cost because the peak of the cost escalation coincided with the summer season. That is the issue. Whether this will be corrected, I think it will take another 3-4 months for it to correct. The festival season has to set in, and it depends on the festival demand. I am not very sure how the consumer sentiments will be. We are not able to conclude that the war is over, everything is good now, the growth will continue. I don't think we are in that stage. We are keeping our fingers crossed. The lost margins to regain will always be very difficult. It can happen only with an extraordinarily great festival season.
Hi, morning, Sajid here. So the probable impact on the margins is going to be around 8% because of the 13% cost. You've been only able to pass on 5 to 6%, and the volume value differential is only 5%, which has gone up for you. What could be the kind of margin impact that you're talking about, and if you're not able to recoup that margin impact?
No, that doesn't work that way. What I'm saying is the cost increase is around 13. Some 8% would have been passed on in our case, and some 5% will be balanced. But you do optimize certain other costs. I have indicated all along, I have been saying this. This may result in an operating margin drop of around 2% in that segment. That's what it will translate to as of now. But still few more days to go. know. We don't know how the June will. I don't have the figures, and therefore this is the real thing. You know, in a great summer season, normally it will be a double-digit operating margin, somewhere around 10%, which may drop by 2 to 2.5% is my concern.
What is the kind of inventory levels that's been carried at the dealer levels at this point in time? Are they in 30, 35, 30 to 45 days of inventory, or is it come down as well?
It has come down substantially. I don't think inventory is anywhere the issue at all. The one and the only issue is the cost escalation. One after the other that was happening, right? There was a energy label change. Obviously, the new designs will push up the cost. Copper, steel, aluminium, exchange rate. So this all continued. And remember, you start buying material, begin building the inventory in December itself. So therefore, later the time, you would have incurred higher costs. So the weighted average material cost will result in some kind of margin erosion. It will be at its peak in Q2. And some more price rise is not ruled out. We have to increase the prices. And somewhere around March, you had the LPG issue, you had the plastics and petroleum-based inputs, whichever is there, those costs have been going up. It has not softened yet.
So, Mr. Tyagarajan, if you look at FY27 as a whole, uh, you're going to see a good volume growth coming in, but margins will remain pressured largely for the entire year, given the fact that you still have uncertainty of West Asia.
It will be too early to say that what are the other positive things that are going to happen. I do not know. I do not have the visibility. When we are in a crisis, we always imagine everything to be, in a bad shape. I suppose some good things also happen in the second half of the year. My view is that again, I have been saying this. There is intense competition. The market is growing, and this growth is over the last year. Last year was a bad year. The important part is whether 19% CAGR for room air conditioners will continue. My hope is it will continue. Whether the price corrections will take place, it will take place. It may not take place immediately. It will take time. Now, the operating margin outlook, which in the beginning of the summer, I stated that it may be between 8 to 8.5. If you ask me now, I will say 7 to 7.5 for the full year. That's what is my guess and some estimate. But we have to verify this in about 2-3 months' time.
Thiagarajan, I'm also curious to know about the faster growing segments. And for you, one of those segments will be data centers and data center cooling. It's going to be a key raw material for AI and the AI play, and you're at the center of it. Give us a sense as to how strong is demand, how much of the top line will comprise of this segment in particular. Give us some color around metrics of how this particular vertical is shaping up.
Thank you, Harsh. Fortunately, we are not only a room air conditioner player. We have great interest and substantial presence in B2B part as well. So there are two segments which are doing well. One is the data center. The other is manufacturing, like the solar, EV, semiconductor. That part also is doing well. So as far as data centers are concerned, there are three parts to it. One is the MEP or EPC contracting part of it, where we are leaders. The market size will be 3,000 to 4,000 crores, and demand is unprecedented. And we will be having an order book of close to around 2,000 crores. We think that we will continue to grow in that particular part. The second part is the chillers meant for coolings, conventional chillers. where we have a strong presence, and I think the market size will be anywhere between rupees 1250 crores to 1500 crores. There is a third emerging part, which are the high-tech cooling or the contemporary cooling meant for data centers, like the liquid cooling, where we do not have a presence. We are in the process of finalizing our partnerships. And all put together, the outlook is around 20% of BlueStar revenue by FY29 will be from the data center segment. That's a sense you will get it.
And could you, so you've broken up the total market beautifully for us. What's your target in terms of market share in each of these?
In the EPC contracting part of it, we will have close to around 40% market share at the moment. And as far as the chillers are concerned, in data center segment, it will be 15 to 20%. In CDU part, which is a small one, the market today will be anywhere between rupees 250 crore to rupees 500 crore. We do not have a presence there. We are in the process of finalizing the partnership. That will be a rapidly growing segment. This is where we are.
FY29, what is the kind of growth clip you grow by? What's the broad target? I know a lot of it is dependent on summers and the like, but is there a growth clip? Maybe 10%, 12%?
I think, I guess it will be somewhere around rupees 20,000 crores, let us say, minimum, and rupees 4,000 crore coming from data center segment.
Okay, thank you so much, Mr. Thiagarajan, for coming and giving us that. That's our headline, of course. 4,000 crore from data center alone, FY29. That's what we're penciling in. Okay, and with that, completely timed out on this edition of Trades from Sajid, Aisha, myself, everyone who puts the show together. Thanks so much for tuning in. Stay tuned to ET Now, Midcap Masala, to carry all the action forward.